This lesson will be focusing on exchange rates. So what are exchange rates and what effect do they have if they fluctuate? So what are exchange rates? Countries have their own currency, which they use for domestic purposes. This means that when transactions are conducted on a global scale, one currency must be converted to another. For example, if you want to buy a computer software program you saw advertised on the internet from a business in the USA, the US business will want to be paid in US dollars, not in Australian dollars. Similarly, if an American tourist visits Australia, he or she will pay for accommodation, restaurant meals, and other products in Australian dollars, not in US dollars. Therefore, in all global transactions, it is necessary to convert one currency into another. This transaction is performed through the foreign exchange market, commonly abbreviated to Forex or FX, which determines the price of one currency relative to another. Exchange rates. Foreign exchange dealers around the world are constantly buying and selling each other's currency. In this way, the price or value of each country's currency is established. This value, or price, is called the exchange rate. So what is foreign exchange? The foreign exchange rate is the ratio of one currency to another. It tells how much a unit of one currency is worth in terms of another. For example, if an Australian dollar was US 70 cents, that means that 1 Australian dollar is worth 70 cents US. Conversely, 1 US dollar would be worth an Australian $1.43, so $1.43 in Australian dollars. So to get that, you divide 1 by 0.7 and you get 1.43. This is what the calculation equation looks like. So C, which is money after exchange, equals A, the money that you have, times B, which is the exchange rate. So the money that you have, let's say, is $1 times 0.7 equals $1.43, as in the case of the previous slide. So for example, if you had 1,500 US, times it by 0.7, which was the exchange rate of said country, let's say euro, then you would have 1,500 times 0.7618, and you would be left with $1,142.70 euro. Obviously, this exchange rate, will always change depending on the fluctuations in the economy and in the foreign exchange rate, which you would need to use the Forex or the foreign exchange to determine. Okay, so what are the effects of exchange rate fluctuations? So how do fluctuations affect the exchange rate? Exchange rates fluctuate over time due to variations in demand and supply and demand. Such fluctuations in the exchange rate have positive and negative effects on the Australian consumers and businesses. Depreciation. So for example, suppose that the value of the Australian dollar falls from US 70 cents to US 60 cents. This downward movement of one currency against another is called depreciation. Of course, this means that the value of the US dollar has increased against the Australian dollar. So with 1 US dollar now being worth $1.66. The impact of depreciation. The impact of this currency fluctuation is a depreciation lowers the value of the Australian dollar in terms of foreign currency. This means that each unit of foreign currency buys more Australian dollars. However, 1 Australian dollar buys less foreign currency. A depreciation makes our exports cheaper, so what we export to other countries, other countries buy cheaper on international markets, but the prices for imports are going to rise because when we want to buy from other countries, it's going to cost more because our currency is worth less. Impact of depreciation. So depreciation, therefore, improves the international competitiveness of Australian exporting businesses, which in turn affects profitability. We will make less profit if our currency depreciates. However, imported goods, overseas travel, and foreign shares, as well as investments, will cost more. so Australian consumers are worse off. Appreciation. A currency appreciation has the opposite impact. An appreciation raises the price of Australian dollars in terms of foreign currency. Each unit of foreign currency buys fewer Australian dollars. The result is our exports become more expensive and the price of imports fall. So when our exports are more expensive, it means more countries are less likely to buy from us, and the price of our imports falls. So what we are importing from other countries is cheaper because our dollar is stronger. The impact of appreciation. An appreciation, therefore, reduces the international competitiveness of Australian exporting businesses, which in turn affects profitability. Because less countries are likely to buy from us because our currency is too expensive, they can't afford our products. However, imported goods, overseas travel, and foreign shares and investments will cost less, so Australian consumers are better off. Balance of trade. Export sales generate foreign exchange earnings, that is, money from other countries that comes into Australia as a result of selling Australian goods and services overseas. It's usually better off for our economy when export sales are greater than the amount of imports. So our economy is always going to be better off when we are exporting more than what we are importing. So more is going out than it is coming in from other countries. If imports are greater than exports, this creates a negative balance of trade, which can lead to foreign debt. So if what we're importing from other countries is more than what we're sending out, this is going to be a negative balance of trade. Over time, foreign debt can become a serious economic problem. So this is just to give you an idea of our, obviously, exports go out, imports come in, and that is dependent on our foreign exchange. So the depreciation of our currency will mean more exports because more countries can buy our products because our dollar is cheaper. However, importing from other countries will become harder. Yeah.